Hi, everyone. Thanks for joining us. Really excited to be running this session on Flag. I'm Seth Hamid, CEO and founder of Altruistic. We're a sustainability data management company. We typically work with a number of Flag-centric businesses, cosmetics, apparel, food, etc. We've also been collaboratively working together with the SBTI team on sharing back feedback on the new Flag guidance as well. So this is a topic quite close to our hearts. We've also convened a Flag working group or a land working group of our customers that we work with to really explore this topic. So really trying to bring together some of those insights for everyone here today. Conscious that we have a relatively short session. What we're going to do right now, we have almost 100 participants from business sustainability teams around the world, some of the largest companies. Super excited to have you, but also conscious of your time. So what we're going to be doing here is we're going to be spending maybe around 10 or 15 minutes running through a bit of an overview on content and just some of the learnings that we're seeing in this space from a data perspective. And then we're going to open up the rest of the time to questions. We've had a number of questions shared in advance. I have a bunch of them up here in front of me, and we'll be going through some of those. But equally, please, if you have any other questions, do share them in the comments. Excited to cover those off as well, and the team will sort of surface them with me on a separate screen so that I can reflect on them as we go through. So without further ado, I'm going to go into some of the content here, and really want to start with the focus areas for today and what we want to leave you guys with. And so there are 4 themes that we have that we want to cover. One is a bit of an overview on Flag, what it means. Conscious that around the world we have sustainability teams at different stages on the journey when it comes to understanding not just Flag, but emissions measurement in general and target setting in general. And so we're going to give a bit of a recap and a bit of an overview on what we mean when we talk about Flag. The second, and this is, I think, the more interesting piece for those of you who are more familiar with the topic, we're going to talk about what shifts we can expect, what we're already seeing play out, what Flag we think is going to enable, and so on. The third piece we're going to come to is maybe a bit counterintuitive, but really every sustainability team now is being asked, in the current economic climate, is being asked by their business stakeholders to show them the money in terms of what the value is expected to be from improved sustainability. There's some really good survey data out there that suggests that almost 90% of businesses, and particularly large businesses and mid-sized businesses, are looking to invest more in sustainability in the coming 2 years. I think that's a survey by Gartner. At the same time, there's really good research by McKinsey, amongst others, that suggests that around 40% of businesses aren't yet seeing significant financial returns from the sustainability investments that they've made. To an extent, I think some sustainability investments will make money and others won't, but it's always going to be relevant for a business sustainability team to understand the business cases and how they can actually position this topic in a way that can bring it the attention of other business stakeholders within their organization. And then finally, we're just going to put that in context in a few different scenarios and how you can see this topic from a Flag emissions measurement and management perspective, how you can position the business case internally, and what the different scenarios are. So those are the 4 things that we're going to land on. I expect we're going to spend the bulk of the time talking through 2 and 3, but then we're also going to touch on a few of these topics in terms of the questions that we cover. So maybe just to start with, overview on Flag. Really, there are 3 core areas, and I'm going to talk a bit about each of those, but also we see each of those 3 areas of Flag impact through the prism of the existing scope logic, and that's very much in the vein with how SBTI and the GHG protocol are also approaching this topic area. So when we talk about Flag and kind of the whole related space, forestry, land use, agriculture, etc., the first category is really around land use change. And we're looking at getting a better understanding with Flag standards of the land use change that has happened both within the company's context, its own operated context. This will be relevant for a lot of farm operating businesses, for example, particularly in many locations where deforestation is a potential risk area. But then also land use change in the supply chain. Think of anyone with, let's say, a palm oil exposure, many other crops and commodities as well. So any land use change that's happened where the original state that the land was in is being transitioned, especially from like a a natural or a wild state to a more managed environment. That's the sort of land use change category that we're thinking of. The second is around land management. Here we're really talking about land management practices, everything in terms of how the land is farmed, fertilizer, pesticide, etc. Regenerative agriculture, most of those interventions will come into this as well. And it's not just around the land management practices of your own business, which will again be relevant for any company that's operating farmland, for instance, but it'll also be land management practices in your supply chain. I'm going to maybe pause before going on to the third one, because land use change and land management will both present very similar complexities and very similar challenges to most companies, which is twofold. One is that when it comes to farm operating businesses, and for example, at Altruistic, we work with a number of the largest farming companies in the world, you're used to looking at certain types of data. You're used to looking at, for example, volumes and tonnage in kilos of output. You're not always used to digging into some of the data streams that you're going to need to understand better in terms of land management practice, or you're not usually storing that data in a way that you can use it to generate a greenhouse gas inventory, for example. Let alone these aspects, when you sort of come to the supply chain side of it and understanding land use change within the supply chain or land management practice change within the supply chain, that's going to present a lot of complexity and a lot of challenge. We also think it's going to present opportunity, especially for some of the big movers. I wouldn't just say the fast movers, but more the big movers in this space, and I'll come back to that. But land use change and land management will both present the same sorts of challenges for many types of companies. And then when we look at the third category covered by FLAG, it's around removals. And here we look at both biological and technological. So everything that you think about when you look at natural sequestration, crop, soil carbon stock increases, etc. But then also the technological side, direct air capture, and so on. To benefit from removals as a positive revenue stream, which is what the opportunity will be for most companies that explore this the right way, you're going to need to manage for ongoing monitoring of storage capacity, traceability. You're going to need a lot of primary data, because it's not possible for you to use extrapolation or estimation in that removal category. And so that's going to be one important shift as well as we think about this topic. One of the big introductions really of FLAG, and I think there are a couple of meaningful introductions, and we'll talk about that in a moment. One of the meaningful introductions is that it's really focused around changes in carbon stock. And so if you think of land use change, let's say transitioning from forestry to agriculture, a natural forest to an agricultural site or farmland, you're looking at a change in the carbon stock level that happens as a result of that shift. Similarly, with land management practice change, you're looking at a shift in the carbon stock, either up or down as a result of practice change. And it's the same case with removals. So the sort of FLAG standards are really a carbon stock-based lens. And one of the big pressure points that this will place is also going to be on additional soil testing and sampling and so on as well. And a number of businesses that we've spoken with have raised that as a challenge that they're going to have to face and come to terms with, which is how do you find enough people with the right skills to go out and do this sort of testing and sampling, but also how do you arrange the financial mechanisms to make that worthwhile? Just moving along, I kind of want to reflect a little on what the current state is and what shifts we expect FLAG to drive. And I'm looking at this through three lenses. One is data and measurement, so everything around the GHG inventory, but just also how you acquire and store and manage data from your business and your supply chain. And then also the analytics side, which is more around how do you use that data, process that data, and use it to derive insights. Normally, you would expect data and measurement and analytics to be treated in kind of one lens and one framing. But as anyone who's been collating a GHG inventory or carbon baseline or a carbon footprint knows, the measurement itself is a massive pain and a massive effort in its own right. And many companies are only halfway or 2/3 of the way through that process right now, let alone actually being able to run meaningful analytics on it. Obviously, many of the companies that we work with have been measuring their emissions now for a couple of years, but the shift from doing this, let's say once every year or 2 years, towards doing this quarterly or monthly or more frequently is a massive shift in transition. And so I've treated analytics here separately. And the third piece that I'm looking at is impact reduction. I actually think that impact can be seen in a positive and a negative context. So especially with the flag lens, you can look at actually positive impact in terms of net negative or net sequestration beyond what the emissions potential is at the emissions contribution is at the farm or the site. But here we're looking at emission, where we're framing it as impact reduction because that's the way that most companies are thinking of this today. And if you think about the current state, a lot of our capabilities and what we can really control with some level of robustness and credibility is around scope 1 and 2. And so if you think about what we can do within scope 1 and 2, we can gather the data quite easily, we can work the data quite flexibly, we can run quite detailed analytics around abatement planning where you can get to the precision of saying which warehouses am I going to put solar panels on the rooftop of first versus later. Electric transport for logistics that you own or control, for example, you can get a pretty robust sense of what to do because you have data that is good enough for you to work in that way. You have data that is accurate enough and credible enough, and you know what went into it, and therefore you can actually make decisions on it. And when you think about impact and reduction, for example, with scope 1 and 2, we're seeing an increasing transition to companies having a set budget for emissions reduction. And that set budget can be used to finance the most promising interventions. And it might also be used ultimately to purchase offsets, for example, where those reductions fall short. But that link between the budget and the impact right now is most credible only with scope 1 budgeting as well. And seeing, sorry, I think the screen blipped for a moment there, and having scope 3 based budgets as well for scope 3 based reductions. Great examples, for instance, with Arla, for instance, is one company which is already paying money and through the milk check into their dairy suppliers and able to actually work with their I'm going to then talk a little bit about some of the shifts that we're seeing as well. And so if you think about a few of the big shifts happening on data and measurement, for instance, what we're going to be seeing, this is probably the most impactful shift that's likely to happen, is going to be the shift towards having purchasing data that is weight-based. Most companies that are doing their scope 3 emissions measurement right now are still using purchasing spend-based data to approximate. Whereas that's not really going to work in a flag context. We're going to have weight-based data. Also, a lot of quantitative data or metadata is going to be needed to supplement that weight-based data. So think about, again, the land management practices, the land use change. That's going to be a qualitative lens that you're going to need to have combined with the quantitative aspect of what that data is. And you're going to need to have both of those together for you to be able to leverage flag-based emissions measurement in a SBTI compliant way, to say the least. If you think about the analytics, and this is a little more on the positive side, because you're gathering much more precise, much more accurate, much richer data sets from your supply chain, and obviously this is going to be a challenge, and we'll talk about this in a moment, but because you're able to do that, you're also going to be able to run the extensive modeling that you would normally be running with scope 1 and 2, but you're going to be able to run that with scope 3 or parts of scope 3 as well, because you have much greater visibility and much greater granularity and accuracy over the data that you're working with. We also think that product level sustainability R&D is going to be significantly accelerated. And that's going to be because you're able to now start seeing a sort of product as a layering on of different emissions contributions from the different materials that are going into it. And you're going to be able to make a much more nuanced comparison between different sorts of materials, because you're not just looking at broad brush global averages or regional averages on spend base. You're actually being able to look at specific suppliers that are managing land in different ways, supplying you with the same material, and the impact that you could have at a product level by replacing one of those suppliers with another, or one type of material with another, for instance. On the impact side, this is probably going to be the biggest positive area of shift in terms of what you're able to do. And so you're going to have a much clearer idea of what it's going to cost you to actually drive a lot of the reductions that most companies have already committed to. So if you think of most of the large Fortune 500 companies, most of them have already put a significant element of brand credibility on the line in terms of their targets for Scope 3 and their SBTI targets for Scope 3. And therefore, for them to be able to get a much better sense of what it's going to cost to actually drive a lot of these reductions that come from Scope 3 and that come from purchases, that's going to be a big plus, because it takes away the cloud of uncertainty around what this is going to entail. But additionally, you actually also create some complex new revenue streams. And we're going to talk about those in a moment. But really, I would see this through two lenses. One is let's say, an opportunity cost-based stream, which is the amount that you would otherwise spend, let's say, on offsets or taxation, or even potentially some of the most expensive internal interventions. You might be able to find cheaper interventions in the supply chain because you have an element of certainty and a certainty of understanding of what it's going to cost you to get those opportunities active. And that can substitute those supply chain based opportunities for some of the other opportunities you might be looking at, offsetting or, for example, taxation or what have you. And that's the opportunity cost based angle. I'm thinking of this very much as like what would go into the model or the spreadsheet for the analyst that's working on this. The second stream that I would think about is a net positive or net additional revenue stream, which is, could you actually monetize some of the potential within your supply chain and help your suppliers to monetize that potential and bring it to market. That's where I think there's going to be a pretty steep learning curve, because most of the businesses that have the most at stake from Flag are used to selling physical products. And when we talk about carbon offsets and carbon insets and whatever you want to call the reduction potential here, we're effectively talking about something that is much more similar to a financial product, an engineered product, and almost like a service even, where you're selling the potential to remove some emissions from the ledger of the business. And the ability to sell that effectively. And I before starting Altruistic, I also co-founded a nonprofit that's in the carbon offset development business as a nonprofit activity. And I see some of the complexity there in generating effective contracts and pricing structures for these instruments. And I think that's going to be a big learning curve for a lot of the larger companies, let alone a lot of the suppliers sitting in their supply chain. So I think that's going to be an interesting area as well. I want to talk a little bit about those revenue streams and opportunity costs in more detail. This is a sort of a relatively quick piece of analysis that we pulled together. We did it originally very much for our own internal consumption and our understanding. So happy to take any feedback on this before we sort of share it more widely externally. But what we did was we basically plotted a few of the benchmarks or a few of the comparison points up on a chart. And I'm just going to kind of talk through a few of the ones that you see on the page here. We've sourced them all from other sources that we thought were credible in this space. If you kind of look at the first two columns, you see the delta of what a farm-based intervention could cost to drive a ton of emissions reduction. And this delta is negative $229 per ton, which means it actually generates positive money, and it goes all the way to a cost of $14 per ton. And that's we actually took that range from a marginal abatement cost curve developed by McKinsey about a year or two ago, with a focus on farm level emissions. And the range we took was for the 85% of emissions reductions that were below this range. So basically, there's 15% of the emissions pie that would cost more than $14, but 85% of those farm level emissions reductions, per this McKinsey piece of analysis, cost between a negative $229 and a positive $14. Obviously, there's a lot of stuff that glosses over. There's a lot of implementation headache. A lot of those costs won't materialize in the same way, but gives you a ballpark idea of kind of ranges. On the $65, we kind of look at what a forestry-based, just to correct myself, the minus 229 to the 65 is the range for farm-based emissions. The $14 is actually a forestry-based offset emissions reduction from a gold standard report that we saw, where it costs $14 to purchase a high-integrity forest-based offset. So if you look at minus 229, that's the kind of lowest end of the range, the cheapest, which is for a farm-based inset. $14 is for a reasonably credible forestry-based offset. $65 is the more expensive end of the farm-based inset. We're just sort of working these up in terms of stacking them up based on price. Then you have the kind of pricing based on the carbon tax regimes. That's actually should be a 160, but $160 is around the Inflation Reduction Act carbon tax peg for direct air capture, and you've got up to 180 on that. So if you kind of look at the range there, and then the benchmark that we've got here in the middle is CDP's assessment of what the median internal carbon pricing is for most companies that are reporting on that. This is around $26. We expect that to be a bit low versus what you'd see now. These numbers are from 2020. Encapsulated in a 2021 report. We expect those numbers to actually be trending higher, and you see some numbers. I think I saw a Co-op Switzerland number, which was in the 150 range, and obviously a lot of oil and gas companies that are forward leaning on this are coming out with numbers that are, again, $100 or higher, so 26 is a bit low. But just to recap, if you look at the potential for a lot of the farm-based reductions, ranging from -2 to 9 on the low side to 65 on the high side, they're actually quite cost competitive with everything except for a forestry-based offset. We also expect offset prices to rise. We expect offsets to also become a bit more like a commodity, an expensive commodity, a bit more like a commodity, in the sense that a lot of the marketing co-benefits that you currently get from investing in large iconic offset projects are likely to diminish. We think that there's going to be a continuing fiscal emphasis also on the development of the offset industry and direct air capture and technological offsetting in particular. We see this a lot from legislation in the US, but it's likely going to follow suit in Europe and the UK as well. And so on the whole, we think the trajectory is going to be towards more taxation, and more taxation linked with more incentives for direct air capture and technological offsetting as well. There are a few different scenarios on this. Bloomberg, NEF has put together a few interesting scenarios that I encourage everyone to have a look at. But to come back to the flag topic, if you look at the potential for flag-based emissions measurement to actually identify alternatives that are much cheaper than taxation and cheaper than offsetting, there's a really strong case to be made there. If I kind of look at three scenarios that we think are possible, and I'm kind of going to go through all three of them together. If you think of an internal sustainability team making the case to its business on whether to go the extra mile towards measuring flag-based emissions, given the additional effort that this is going to take in terms of engaging the supply chain, gathering data, there's going to be an expense involved for sure. Really, there are three scenarios that you could be thinking about. One is where you actually sort of carry on without the land-based emissions. The second is where you kind of measure the land-based emissions, but you don't go the extra mile to make this SBTI compliant per the new guidance. And the third is where you kind of go the whole 9 yards and you follow the new SBTI guidance as well, and you actually move towards a standard where you're actually engaging with your suppliers in the most robust way. If you look at these three scenarios, I think that frankly, one of the worst places to land ends up being the middle scenario. I know usually the middle scenario is sort of indicatively the best scenario to be in, because you're going to probably end up going through most of the same effort in scenario two. And so if you think about the first scenario, I think that is, scenario one is really decreasingly tenable, or will very soon not be tenable for most businesses that want to, let's say, trade into the EU, for example, because if you look at the legislative direction in Europe, it's mostly going to capture not just all large and even medium-sized companies in the EU, but also everyone exporting into the EU. US is following suit very rapidly. So I think there's a window where you can kind of get away with not measuring your land-based emissions at all. And that's that kind of first scenario. And you can defer that for a year or two. And, to an extent, deferring it for a year or two is for many businesses still a cost advantage rather than getting into it straight away from a sort of a net time value perspective. If you look at the second scenario is where most companies are today, and because most companies have been working on land emissions have been doing so in an environment prior to the new guidance being released, SBTI guidance or GHG protocol guidance, for example, later this year. It's going to involve most of the same effort. It's going to involve most of the same effort to gather a certain level of supply chain data and a certain level of supply chain visibility to make this possible. But if you don't actually go the additional mile in terms of understanding actual land management practices, actual carbon stock changes, what you lock yourself out of is two positive upsides. One is the ability to set an SBTI compliant flag target with any of the co-benefits from brand positioning, retail partnership if you're an FMCG, consumer value proposition, all of the sort of co-benefits that you'd expect. But the second thing is it also more or less locks you out of the carbon removals market as well in this space, and means that you're not likely to be able to actually monetize that opportunity. I kind of wanted to pause on some of the on the sort of the presentation side and actually shift over. So I'm going to stop sharing now. We have a number of questions that have been kind of shared through. And so I'd like to go into a few of those. And again, if you kind of have any others, please do feel free to put them up in the comments. If I look at our sort of first question, we have one from Susan, which is, what is the best way of incorporating land-based emissions into current sustainability data calculations? Susan, if you're listening, what I expect you're in the process of right now is you've been measuring emissions for some time, and you're looking to understand how do you avoid reinventing the wheel, and how do you actually just incorporate some flag compliant approach onto what you're already doing. And so I guess the first piece is really that you're probably already collecting a lot of the data that you might need to. And if you think about activity level data from the supply chain and from within your own operations, you may well already have a lot of the data that you need. It just might not be in a structure that you can use it effectively. And so one aspect is how do you actually start to combine that data and structure that data in a way that you can run calculations on it. And if you think about your emissions factors that you're going to be using, for example, a second area is going to be, do you have emissions factors accessible to you that you can actually use weight-based calculations for a lot of the supplier data that you're receiving? I think that another aspect that's going to be important, so the first one is just scan for what you're already doing. The second one is look to the emissions factor databases that you're using and whether you have coverage that you can achieve there. And then another one is going to be around your position in the supply chain, because there's a nuance in the flag standards based on where you're sitting across the supply chain, and whether you're kind of a producer of certain commodities versus a processor, it'll be treated a little differently. And so I think the third piece is getting some guidance, some advice on kind of where you're sitting across your business activities, and therefore what standards will apply to you and in what context. And then I guess the biggest tip that we can see is most companies are going to have a lot of blind spots, and that's fine. This is an iterative journey for all of us. And one of the reasons that the GHG protocol guidance, for example, has been delayed so many times is because it's complex, and because there's so much feedback, and because there's so much difficulty. And so actually iterating at this and kind of starting somewhere and continuing to iterate with what you have progressively, and maybe working with suppliers, for example, in cohorts, is going to be one good way to get there. I'm going to move over to a second question, which is from Guy. Guy's question is, what do good flag reduction and removal interventions look like, and what impact can we expect? If you think about, again, most sort of intervention reductions effectively starting to look like commodities where basically an emission reduced is more or less fungible across different emissions reduced, you really gravitate to a world where the quality of that reduction is seen in terms of the traceability, the ongoing monitoring that you have happening at let's say at the farm level, and just how robust the data is to support the change in carbon stock that's happening there. And so I think there's going to be a big focus on that. When you think about what a good reduction is, it's going to be how credible and robust is that data. Much like your emissions data, for example, is also going to be seen through the lens of credibility and robustness, more so than, let's say, simply what is the magnitude of the number. The other area to think about is the reduction potential or opportunity statistically significant in terms of the contribution it's making. A statistically significant opportunity is also more likely to be an opportunity that has a lower margin of error on the measurement and on the calculations, because it just has more volume to it. And so one aspect of that is going to be the statistical significance. Another is going to be the margin of error or the quantitative uncertainty score that you're able to put on it. Because one way to be transparent and open about uncertainty is to put a range or some sort of a scoring or gradient to it. If we think about a few elements, maybe also just worth calling out of what makes a bad removal opportunity, or a removal opportunity that a company should kind of stay clear of, whether it's being pitched to you ultimately by a supplier, whether you're exploring it as a business case or an opportunity in itself. I think there are two things to be wary of. One is where it's not properly quantified. And so again, you need to move away from estimated data and really go to primary empirical data to be able to quantify these opportunities. And then the second one is around maintenance, because ultimately you want a removal that's going to last. And one of the big advantages that technological removals have, for example, over biological ones, is that it's often easier to demonstrate that they're going to be durable and they're going to last. And so particularly as you think about natural sequestration methods, I think one of the important things is going to be the ability to prove durability and commitment to the maintenance of that reduction ongoing into the future. And you should be, if you take some learnings from the offset market, you should also be able to take a time period and price that into the contract as well, so that maintenance is priced in and effectively paid for. Going to move on to a third question we have, which is from James, which is around what are the main challenges we should anticipate when it comes to measuring flag-based emissions. I think this is an interesting one, and I think that to an extent, the answers are very similar versus what you would expect with most greenhouse gas emissions measurement. And so it really comes down to three things. One is going to be around standardization. The second, I would say, is going to be around primary data gaps and difficulties. And the third is going to be around uncertainty values. All of these three things are also true with standard greenhouse gas emissions measurement, but are going to be even more true when it comes to flag-based emissions measurement. And so if you think about standardization, for example, right now we're in a place where even the guidance is new and is frankly being iterated and refined as we go. And so there's a big element of standards being new, and therefore every company is going to be iterating on this. And it's not just going to be true for you as a business and your peers, but also for your suppliers, where you're going to find that there's a lot of a lack of clarity and certainty across your suppliers as a group. And also different suppliers might be approaching this in different ways, usually with the best of intentions. And so, to round that off, there's also the difficulty where a lot of the databases that you might be using, again, when you think about emissions factor databases, they might be using different methodologies, different structures for data, different periods of time. One of the things that we find, which is a big challenge when working with externally sourced emissions factors, is that the timestamp on them ends up being very different and therefore hard to compare. 2012 to 2020 for an individual factor versus 2014 to 2018, for instance. You kind of have to start piecing apart that data and really looking at provenance and ontology and kind of comparability between different sorts of data coming to you, either from your own calculations and measurements or from what you're receiving from your suppliers. The second is around primary data, and I think really we only have a lot of empathy for most businesses facing this problem, because you've already been facing the challenge of scope 3 spend-based emissions measurement with your suppliers, where you've been working with your suppliers, where many of these suppliers are small businesses, SMEs, that have no real tools in place, no real budget in place, and no real internal capabilities or expertise to get around the data that you need for even a good sort of spend-based scope 3 measurement. And now we're looking for primary data that goes that level deeper. And I think it's going to be particularly challenging when you think about tier 1, tier 2, tier 3 suppliers, tier 4 suppliers, where you have many intermediaries and you're not actually in that direct relationship with your suppliers where you're able to do this. And so a few thoughts on kind of what we see happening here is we see some of the larger buyers and larger companies with many small suppliers in their supply chain really leaning in on tools and support. Webinars, talks, workshops, that sort of thing can be very helpful. Often there's the ability to actually procure tools and software and kind of take that out into suppliers as well and sponsor that for suppliers. Recommendations of what to use, recommendations of what reading materials to go to can be super helpful in helping suppliers on that journey. Selecting certain suppliers that you want to also promote as role models to the rest of the supply chain, both in terms of kind of the great work that you've done with them, but also how you're now deepening your relationship with them as a result, and therefore giving a bit of an incentive to other suppliers. So a great concept that we're seeing with some of the companies that we work with is, can you actually work with a few suppliers on measuring land-based emissions, for instance, across land use change and land management, but then also identify certain removal opportunities that you could work with them on, where you actually commit to purchasing the token that emerges out of that. And you can kind of showcase this to other suppliers of yours in the supply chain to give a bit of incentive for them to engage with you on the primary data exchange and sharing. That's another opportunity that we think could be useful in really getting primary data exchange moving across supply chains. And then the third element that I mentioned is around that uncertainty factor as well. And I think that we're moving to a world where having an emissions measurement in itself, the sort of standard PDF report, is insufficient. And most of the companies that we work with that are taking emissions measurement seriously are now getting increasingly sophisticated around things like accuracy scores, uncertainty measures, margins of error, that sort of thing, not just because it's helpful for them in how to position these numbers externally, but also because it's helpful for them in how to position these numbers internally. One of the big challenges that we hear from business sustainability teams is that the numbers move around too much. I was on a call with a large investor actually just earlier today. They're a sort of a $20-30 billion LP investor into multiple funds. And one of the big challenges that they face is how to piece apart actual emissions reductions versus where an emissions factor has changed, for example. And so similarly, when you think about kind of error ranges and margin of errors, it's quite useful to give an uncertainty range that can tee up and queue up for internal stakeholders as well, how much you expect numbers might move as measurement becomes more accurate and more predictable as well. Conscious we've kind of gotten through quite a lot, and some of this is quite specific to companies that are already quite familiar with Flag, and we've also tried to bring in a bit of a higher level view for companies that are new to the topic. We're going to circulate most of this material in some shape or form, either video or otherwise, with everyone who sort of signed up to attend. Feel free to share this with your networks internally or externally as well. Super excited to have a conversation with anyone who's interested in exploring this topic further. And also wish you guys best of luck for your own Flag journeys as well. So big thank you to everyone. We're going to end the broadcast here.